Your home is worth $800,000. You decide to sell it. 6 months later, your age pension is gone completely. This is happening to real Australian retirees right now in 2026, and almost nobody warns them before it's too late. If you own your home and you're thinking about selling, even just to downsize, move closer to family, or free up some money for retirement, you need to hear this before you sign anything. Because the rules around your home, your pension, and Centrelink are more complicated than most people realise, and one wrong move can cost you thousands of dollars a year. I'm from Centrelink Pension Bulletin, and today we're going to walk through exactly what happens to your age pension when you sell your home in 2026, what the current asset limits actually are, how long you have before the money from the sale starts counting against you, and what you can do to protect your pension while still making the move that's right for your life. Stay with me because the details in the middle of this video could genuinely save you your pension. Let's start with the most important fact you need to understand. Your home, the one you live in, is completely exempt from the age pension assets test. That means Centrelink does not count the value of your house at all, no matter how much it's worth, as long as you're living in it. This is why so many pensioners with valuable homes still receive a full pension, even if their house is worth $1 million or more. But here's where things change very quickly. The moment you sell that home, the exemption disappears. The money you receive from the sale is no longer your home. It becomes cash sitting in your bank account or an investment or savings. And cash counts. It counts fully from the very first dollar under the assets test. Now, here's a fact that surprises almost everyone I talk to. As of the most recent indexation this year, a single homeowner can hold up to $333,000 in assessable assets and still get the full pension. For a homeowner coupled together, that figure is $499,000 combined. Beyond those limits, your pension starts tapering down. Stay with me because the taper is where the real damage happens. For every $1,000 you hold above that threshold, Centrelink reduces your pension by $3 a fortnight. That might not sound like much at first, but let it add up and you'll see how quickly a home sale wipes out a pension entirely. Let's say you're a single homeowner and you sell your home for $700,000, planning to rent for a while or move in with family. Suddenly, your assessable assets jump well past that $333,000 threshold. Once your assets climb high enough, past what's called the upper cutoff point, currently around $733,500 for a single homeowner, your age pension stops altogether. Not reduced, stopped completely. Now I want you to think about that for a moment. Some of you watching this have lived in your home for 30, 40, even 50 years. You've paid it off. You've raised your family in it. And the idea that selling it, an asset you worked your whole life for, could end the pension you also worked your whole life for, feels deeply unfair to a lot of people. I understand that frustration completely. But here's the part almost nobody explains properly, and it's the part you really need to know before you do anything. When you sell your home with the genuine intention of buying or building another one, Centrelink gives you a protected period. The proceeds from the sale are exempt from the assets test for up to 12 months. During this time, the money doesn't count against your pension in the assets test, provided you can show you intend to use it to purchase another home. This is a critical detail because it means downsizing does not automatically destroy your pension. If you sell your family home for $600,000 and plan to buy a smaller unit for $400,000, that difference, the $200,000 left over, is what eventually gets assessed once the exemption period ends or once you buy your new home, whichever comes first. So the danger isn't necessarily selling your home. The real danger is what you do with the money afterward and how long you wait before reinvesting it into another home. Here's where it gets even more interesting, and this is something a lot of retirees don't realize applies to them. Even during that 12-month exempt period, while the sale proceeds aren't counted under the assets test, they are still counted under something called Deeming rules for the income test. Centrelink assumes you're earning a certain rate of return on that money, whether you actually are or not, and this deemed income can still affect your pension payments during that window. Right now, the deeming rates sit at 1.25% for the lower threshold and 3.25% above that, current as of the March indexation this year. So even sitting in a regular bank account earning very little real interest, Centrelink still assumes you're earning that deemed rate, and that gets counted as income. This is exactly why so many people who sell their homes are shocked when their pension drops even before the 12 months is up. They assume the exemption protected them completely. It doesn't. It only protects the asset test, not the income test. Now let's talk about something that's become far more relevant in 2026, and that's the Home Equity Access Scheme. This is a government scheme run through Services Australia that lets eligible older Australians access extra money using the equity in their home without having to sell it at all. Essentially, it works like a government-backed loan against your property. You can receive regular fortnightly payments, or, in recent years, eligible pensioners have also been able to access lump sum advances up to certain limits each year. The debt accumulates against your home with interest, but you don't have to repay it until the home is eventually sold, usually when you move into aged care or after you pass away. This has become an increasingly popular alternative for retirees who want extra cash flow without triggering the asset test problems that come from an outright home sale. If you're feeling the pinch financially, but you don't want to risk losing your pension, this scheme is absolutely worth looking into with Services Australia directly, because it lets your biggest asset, your home, keep working for you without becoming an assessable asset. Let's go back to the home sale scenario for a moment, because there's one more piece of the puzzle that catches people out. Many retirees sell their home not to downsize into something smaller, but to move in with a son, daughter, or other family member. In these situations, some assume that because they no longer own a home, they'll automatically get the higher non-homeowner asset thresholds, which are noticeably more generous. That's true, but only up to a point. As a non-homeowner, your asset threshold does rise. Right now, a single non-homeowner can hold up to $600,000 in assets before the pension starts tapering, and the upper cutoff sits around $1 million. But remember, the money from your home sale is still an asset. If you sold for anything close to or above these limits, you can still lose part or all of your pension, even without a house. This is why the phrase I keep coming back to in these videos is this. It's not about whether you own a home or not. It's about your total assessable assets, wherever that wealth is sitting. I want to pause here and ask you something, because I think it matters. If you're watching this and you're already considering selling, has anyone from Centrelink actually sat down and explained these numbers to you in plain language? Because in my experience talking with viewers of this channel, the answer is usually no. People find out after the fact when their next payment arrives lower than expected or stops altogether. So what should you actually do if you're thinking about selling your home in 2026? First, before you list your property, contact Services Australia or book a financial information service appointment. This is a free service and it exists specifically to help people like you understand exactly how a decision like this will affect your payments before you make it, not after. Second, if you do sell and plan to buy again, get everything in writing regarding your intention and keep track of the 12-month clock closely. Missing that window by even a few weeks can mean the difference between keeping your pension and losing it. Third, consider whether the Home Equity Access Scheme might actually solve the underlying problem you're trying to fix by selling, whether that's needing extra income, paying for medical costs, or helping family, without giving up your home or your pension exemption at all. And fourth, always remember that Centrelink assesses both an income test and an assets test, and pays you whichever result is lower. Selling your home can affect both of these at the same time, in ways that compound each other. This is exactly the trap that catches so many well-meaning retirees off guard, because they only think about one test when both are working together against them. I know this is a lot of numbers and rules to take in, especially if you're not used to dealing with Centrelink paperwork every day, but this is exactly why I make these videos. Retirement should be a time of security, not confusion, and not fear that one financial decision could quietly take away the payment you rely on every fortnight. If today's video helped make sense of something that felt confusing or worrying, please give it a like. It genuinely helps this channel reach more people your age who need this same information. If you haven't already, subscribe to Centrelink Pension Bulletin because we cover exactly these kinds of real, practical Centrelink questions every single week, the ones that actually affect your day-to-day life and your bank account. And if you have a specific situation, maybe you're thinking about selling, or you're worried about the home equity access scheme, or you're not sure which asset test applies to you, leave a comment below and tell me your situation. I read every single one, and it often helps me pick the next topic for this channel. In our next video, we're going to break down exactly how the home equity access scheme works step by step, including how much you can actually borrow against your home and whether it makes more financial sense than selling in your specific circumstances. Take care of yourselves, look after your pension the way you've looked after your home all these years, and I'll see you in the next one.